Next guest thinks the recent pullback in both oil prices and energy stocks offers some opportunities. Let's bring in Art Hogan, Chief Market Strategist with B. Riley Wealth Management. Art, we'll get to energy and the opportunities you see there in just a moment, but I want to start with a bigger picture look at the market in 2023 as you see it. It is relatively uncommon for the market to have, or at least in recent history, it's been uncommon for the market to have two bad years in a row. Do you expect that this year or not?
No, we really don't. I think a lot of the things that we were faced with in 22 have dissipated and are behind us in 23. For example, we don't think the 10-year is going to have the order of magnitude move that it had in 22. It went from 1.5 to 4.25. We'll likely see yields settle down. We'll likely have a peak in Fed hawkishness. We've seen a peak in inflation. All those things will become tailwinds for the market. We have to get through the choppiness of the first couple of quarters. But I think when the Fed gets to a place where they pause, the first two P's and pause and pivot, the market will take that as a positive. And I think that will ignite risk on appetite. And then when they get to the fourth quarter, I suspect they're still going to be at a place where they're going to need to pull back a bit. I think they're going to have a 5.25% Fed funds rate, and inflation at that point in time on the headline level for CPI will probably have a 3 handle. So not entirely impossible. They have to cut by the end of the year. So I think the markets face a different dynamic in 23, and we likely have a more positive year.
All right, let's move on to your argument for several of the energy area stocks: Chevron, APA, and Cheniere.
Yeah, Chevron, fully integrated international and domestic exposure, trading at a very reasonable multiple at or about 10 times and paying a very nice dividend. I think the reason, Pippa just went through this, but one of the reasons we've seen a pullback in energy prices in general and the energy sector in particular has a lot more to do with fears of recession, fears of global recession. It ignores the fact that the dollar seems to have flatlined and likely is heading lower, a net positive for commodities, and certainly doesn't play into the China reopening story and the demand for all sorts of commodities, including hydrocarbons by China. So I think Chevron is one of the best ways to play it.
Does it make you nervous, Art? And hi, it's Kelly here, that oil is off to such a rocky start this year?
No, not at all. I think a couple things. Mother Nature played a nasty trick on the nat gas bulls, delivering some warm weather for a couple of weeks and the end of December, the first part of January. That happens. And I think that when you look at the overall supply and demand dynamics, we certainly are still undersupplied. So any increase in demand, especially coming out of China, we just haven't had enough CapEx spent on oil production by any of the oil producing countries over the course of the last 3 years. So you're not able to make that up very quickly. So any need for new supply is going to be met with a lot of demand. I think the supply and demand dynamics will outweigh this. And remember, most of these energy companies are going to do just fine if WTI is sort of pinned at a $65 to $75 level. So we're not calling for a return to $100 crude. We're just talking about very profitable companies.
Let's talk a little bit about what you describe as a barbell approach to investing this year. On one end of the barbell are the things you say we need, like energy, healthcare, consumer staples. On the other end of the barbell, solid growth companies with a defensible leadership role in their sector, where their multiples have gotten contracted over the past year. What kinds of companies are those? Name some names if you have any, but give me sectors for sure.
Yeah, absolutely. So on that front end, you named it perfectly right: energy, healthcare, and certainly staples, but staples at a reasonable price. They've had a significant run. On the other end of that, you're really talking about growth that is actually attractively valued. And boy, we've created a lot of that over the course of the last quarter or so. So think about companies like Apple, Microsoft, to a certain extent Meta, if they pull in a lot of their spend on other things and address their core business. But I certainly think that Alphabet, Microsoft, and Apple are 3 great examples of multiple contraction. You've certainly seen defensible moats around their business. You've certainly seen shareholder-friendly managements. And I certainly think that the multiple compression that we've seen in those 3 names alone, and there's a host of other ones, sort of fit that bill of growth at a reasonable price.